I began investing when I was 11 years old. I had just wasted time until I was 7, 8, or 9, but unfortunately, I didn't start until I was 11. I bought my first stock at 11 and then dabbled in a series of things like the timing of stock purchases, charts, and all these crazy things. It was a lot of fun, no profit, but a lot of fun, and I did it until I was 19. I read all the investment books in the public library and devoured all of them. It was fascinating to me, but I didn't have a reference. I was just looking for something. I was hoping that small details on a chart would tell me something about what a stock would do. It was kind of crazy, but everyone was doing it, so I thought I should too. Sometimes you would even turn the chart upside down, and that still didn't help. Then, in 1949, I read Benjamin Graham's book, The Intelligent Investor. I had never heard of him until then, and there are really only 2 chapters in that book that are essential. But they established my philosophical framework for investing in 3 ways. They are so basic and simple that it's hard to understand how they can be so important. But the 10 Commandments are simple too, you know. The first is that a stock is a part of a business. You can't think of a stock as something different. You assess a business and then divide it by the number of shares outstanding. But what you have to think about is what kind of business you're getting into. What are its economic characteristics compared to its competitors? How is the management? All these things related to a business instead of just text and numbers on the screen. The second thing in the book is that Graham gives you a wonderful reference point in terms of how the investor should react to stock market fluctuations. He talks about his mythical Mr. Market in Chapter 8. Nothing better has been written in terms of the investor's attitude toward stock prices. Most people react wrongly to stock prices. They feel good when their stocks go up and feel bad when they fall. They think the stock market is there to be a partner, and Mr. Market is this partner you have in investing. He's an incredibly helpful partner. This guy shows up every day and tells you how much he'll pay for your stake in the business or what he'll sell it to you for the same price. No one does this in private business. If you and I had a gas station together and I said every day, I want you to come in and offer me your half of the station, and I can buy your half or sell you my half for the same price, and you have to do this every day, you'd be at a great disadvantage, and you'd be particularly disadvantaged if you were Mr. Market in the market. Because Mr. Market, who kindly provides you these numbers every day, different numbers at the end of the day and at the beginning of the day, but he's fixing a price at which you'll buy or sell. The wonderful thing about him is that he's a manic-depressive alcoholic. I mean, he's as unstable as can be. He's walking around all day, you know, looking at crazy things, and he'll name all sorts of crazy prices, and you don't have to pay attention to them except when it's advantageous for you. If it's once a year, if it's once every 5 years, if it's a stock at 3,000, all you have to do is stand there. You have no moral responsibility to this guy. I mean, he's naming these numbers you didn't ask for, but he's doing it. And all you have to do is choose the moment when he's particularly depressed, manic, or drunk, whatever, and the market will be all these things and you take advantage of it. The market is not there to instruct you, to tell you anything. The market is basically there to serve you when you wish. But people have all these feelings about it. The stock doesn't know you own it. You're there with these Berkshire certificates. The company doesn't even know you own it. And the stock doesn't know either. It's being traded now, and it doesn't know you own it. So it has no feelings about you. You have all these feelings about it, but it's just a part of a business. If Berkshire is worth 75,000 times 1.5 million shares, approximately 110 billion or something like that, it's a good investment. If not, it's a bad investment. You need to evaluate the business, but people don't do that on Wall Street. Actually, one of the things I always like to do when analyzing investments is to look at them without knowing the price, because if you see the price, it automatically exerts some influence on you. When I used to bet on horses as a kid, one of the things I did was to get the racing form in advance. If there were 9 horses in a race, obviously, the odds of each of them winning the race had to add up to 100%. I mean, a horse was going to win the race unless there was a tie, or they all dropped dead on the track. So if you looked at the racing form, I would try to calculate the probability of each horse winning the race, and that had to add up to 100%. Then I would compare those percentages with the odds. But first, I wouldn't look at the odds. First, I would look at the past performance and all the information. The stock market is the same way. The third thing in Graham's book is the margin of safety. If you come across a bridge that says capacity 10,000 pounds and you're driving a truck weighing 9,800 pounds, you look for another bridge. No one knows exactly what that capacity is, and it could be that the sign was put up 3 years ago, so you always leave a margin of safety. This is in The Intelligent Investor, and I've never found anything remotely comparable to all 3 points I mentioned. But I would say the most important thing over a long period and dealing with a lot of money is to understand the business. Let's assume, for a moment, you have $1 million or whatever it takes, and you can look in Knoxville or all over Tennessee and buy stakes in 3 companies. You have a week to do it, or you have to return the money. What will you be doing over the next week? You can analyze all these companies. Some of them you know well, others you know less. Some you know by reputation. Some you know the management, and others you know the competitive situation. What will you be thinking during those 7 days? How will you really filter these companies? You will seek out 3 companies, and you won't be able to trade them after the purchase. You will own them for the rest of your life. You will look for companies that have a lasting competitive advantage. It's not necessarily about the company that is making the most money right now. You want something with a lasting competitive advantage. Now, this requires a business with some kind of moat around it because capitalism, by definition, is a system where whenever someone builds an economic castle, someone else will come behind. That's the nature of the system. If you open a successful restaurant here in town, you know someone will take your menu and probably your chef, maybe lower the price, maybe offer more parking, maybe be better in some way, whatever it may be. Capitalism is about competing for each other's castle. If that's the case, you want a castle with a big moat around it. There are many ways to have an edge in something. You can have it through patent protection. You can have it through being located in specific areas. If you have something in people's minds like Coca-Cola, 6 billion people in the world, practically all of them have something in their minds about Coca-Cola, largely favorable. They have nothing in their minds about RC Cola. And if RC Cola spent $1 billion on advertising, they wouldn't have anything in their minds about RC Cola. But they have something in their minds about Coca, and it's generally favorable. That's why Coca-Cola wants to be where people are happy, because they want to be at the theater. They want to be at Disney World. They always want you to be drinking that Coca-Cola while at the same time experiencing happiness. And if they do that, they're going to sell a lot of Coca-Cola, and it won't make a difference if someone serves half a cent less of some portion than Coca-Cola. That's a lasting competitive advantage. And you want to have honest and capable partners. You don't want to get involved with swindlers, and you don't want to get involved with incompetence. Now, the best businesses to buy are the ones where you could have an incompetent in management. Peter Lynch says, buy a business so good that an idiot can run it, because sooner or later, an idiot will. Those are the kinds of businesses you want to own. So, you want capable and honest management, and then you want a price that makes sense. That's what you would look for. You'd go through Tennessee in a week and immediately eliminate several things, knowing it wasn't a fertile area. Knowing how to do that is important. Knowing how to get rid of various things. There was a great article in The New Yorker magazine 30 years ago when Bobby Fischer was playing against Spassky in the famous chess game that captured the world's attention. They examined how the mind can, among billions and billions of possibilities, group things to immediately reduce them to about 4 options. Investing is very similar to that. It's not as difficult because there aren't as many companies, but you want to eliminate all kinds of unfavorable things. If someone told me that my life depended on choosing from the Dow Jones stocks, a group of 10 that would be the best performers or outperform the index as a whole, I would spend my time thinking about the worst companies among them. I would discard things, and then I would think I left these behind. That's actually an easier way to approach the problem than trying to pick the top 10. You have 3,000 companies you can invest in on the New York Stock Exchange. There's a valuation for each of them. This will change tomorrow. You don't need to analyze only once a year. If you have 20 good ideas in your lifetime, you'll get very rich. Sometimes I tell students that maybe it would be better if they had a punch card when they left school with just 20 points on it, because instead of hearing someone at a party and the next morning buying some stocks, they would actually think about each point. They're all the points you have. 20 points are more than enough. You just need to make sure you don't use any of them for frivolous reasons. We never want to buy something small at Berkshire. It just doesn't make a difference. We want to think about things that can have a big impact. And that gets more challenging as the capital increases. But that's the way to focus on investments.